Hey traders, welcome to my private trading library. This video is about the options chain and the trading page in Thinkorswim. I'm going to point out some of the features of this page, and then we'll look at an example stock and the chart and see how do we select which option to trade. And there are several different ways, but I'll just point out a few as examples. So here we have the ticker, the description, the market price, the range of price movement today, 1%, and went up $1.64. The bid ask. ETB stands for easy to borrow. That means it's going to be easy to borrow shares, to sell them or short them, and then buy the cover. Trading on the NASDAQ. And this here, MMM, stands for Market Maker Move. And the principle of market makers is an important one, and I go over that in some detail in some of my other articles on medium.com and one of my ebooks that I've written and some of my other videos. But what this means is that market makers believe that match has got some additional movement or volatility of plus or minus 1.25, and they are pricing that into these options. Now, before we get into the options chain, let's scroll down to the bottom here, and there's some other information on volatility, which if you're into trading volatility, you can look at that. But what I like to look at is this put-call ratio. If there's more puts than calls, that means that most of the traders are trying to profit from a downward move, and therefore the sentiment is thought to be negative. So if the put-call ratio is above 1.0, that means there's more puts than calls, then that means their sentiment is negative. If the put-call ratio is less than 1.0, meaning there's less puts than calls, then since there's more calls, people are thinking that the price will go up, so the sentiment is considered positive. So in this example, for match, the put-call ratio is less than 1.0. There's less puts than calls. That means that the sentiment is thought that match is going to go up. Let's look at our chart to see if that coincides with the chart. Here we have the 8 simple moving average above the 21, so that's still stacked positive. We have a squeeze forming, and it's possible that the MACD might be trending up. If I do that, so the MACD is maybe reversal there. So if this squeeze fires while this is reversing up, crossing up in a golden cross, then it is possible that the price action will move up as well. Now if we go back to the options chain, we're going to go here to the monthly. This number here is the implied volatility that is priced into these options. And so what you can do to establish a trading range on or before October 15th is you can get a calculator and you can determine the upper range of trading by adding this number 11.98 to the market price. So 158.63 plus 11.987. So $170 is the upper trading range for match on or before October 15th. On our chart, where does that coincide? It's going to coincide with about here. So that'll be interesting to know, because if we know that price is going to go up based on the stacked simple moving averages, the MACD, and possibly even the the RAF or stochastics, that you could enter a long position in a variety of ways. You could buy calls, you could sell puts, you could buy a debit spread, you could sell a put credit spread that profits from being above a certain level, or you could even trade something called a butterfly. And we'll look at those types of trades in just a moment. So let's go back to our options chain. And I've got it set to single leg options right now. And you can customize the layout. I have it as open interest, volume, delta, bid ask, expiration, strike price, and then the same for puts. And I like to look at the open interest to see where all the volume is, in a way that is institutional smart money too. But let's look at the variety of trades that one could take in this example. One way to do it is you could trade in the money options. And one acceptable method is to buy what's called Delta 70. There's been a number of studies done where this delta number had the maximum profit percentage by trading the delta 70 of all the option choices. And what this number means is that the price of the option will go up by this amount for every dollar that the price goes up. So, for example, if this 155 option, and let's say you bought it for something like $7 in the middle of this bid ask, and that's a very wide spread. I wouldn't like that. But let's just say, for example, you did buy this option 155 strike for $7. So if the price of match went up to $156, that the option will go from $7 plus 63 cents. So it'd be $7.63 if match went to $156. So you can see that a gain of 63 here is a huge gain from $1 price movement. Whereas if you were to buy something, let's say out here at the 180 strike, yes, there's a lot of volume there, but look at the delta. So you're going to buy a option for something like 10 or 15 cents, but it'll only go up 4 cents for every dollar that it goes up. And we already established from our calculation that the market maker move, the expected range of trading movement, is up to $170. So if it were me, I would want to buy some kind of call at this level or below, because that more likely become an in the money, and the price of the option will increase faster than if you were to buy out here. So that's single leg options. You could do also vertical spreads. And what a vertical debit spread is, you're buying a call still, but instead of paying $700, you're going to reduce the price of your purchased call by selling a call further out of the money. So for example, in this example here, I might buy this 155 debit spread. There's the 155 here, but instead of paying $700, I'm paying $135. Now the risk here, or I guess not the risk, the limitation, is that my profit potential is limited by the short strike. This one is the short one, it's being sold. And so I can only make the money here, this much money, okay? So the way it works is the width of the spread minus what you paid for the spread is your max profit. So the width of this spread is 2.5. So if you bring over your calculator, the width of this spread is 2.5, and you're paying $1.35, so you're subtracting that, what you paid for it, out of your money. So the maximum I could make if if a match traded up or above 157.5, the maximum I could make is $1.15 per contract. But since it's 100 shares, the maximum profit is $115. Now let's look and see if that matches up with the thinkorswim calculation. Yeah, absolutely. So there's the $115 that we calculated here. Right here. So that's how you do a debit spread. Now another way you could do it is you could sell a put credit spread. Now let's look at the chart so that we understand the difference between a debit spread and a credit spread. With a debit spread, you're buying a call with the expectation that it's going to increase in price action. With a debit spread, you buy the call, but you're kind of capping your profit based on where the short strike is. With a put credit spread, you're going to be selling the spread, and you want it to be above a certain level. So what you would do is you would determine some level of support, maybe here, or maybe even safer down here if you can, and you will profit from a credit spread so long as the price is above a certain level. So when you look at the option chain, let's look back at the chart that the support level is somewhere right here at 152 or below. So if you look at the selling a put here, 152, we could sell here or here. It would be safer to go further out, so we can sell this one. And if you were to sell this put credit spread, your maximum profit is what you sold it for, which is going to be $74. But the max you could lose is the width of the spread minus what you sold it for. So you're going to take the maximum loss, which is 2.5, minus what you sold it for. You earn that, so it's going to be 2.5 minus 2.5 minus 0.74. So your maximum gain is $74. Your maximum loss is the width of the spread minus what you sold it for. So the maximum I can gain is $74. The max I could lose is $176. And let's see if that matches up. So once again here, the max profit is $74. The maximum I could lose is $176.